Welcome back. In this video, we shall be discussing the stage 2 of the financial crisis, which is the banking crisis. In the last two videos, we had discussed the various factors which can contribute towards initiation of a financial crisis. However, in this video, we'll discuss the banking crisis. As you would have seen in the couple of videos, we have been discussing about the declining balance sheet position of the banks, financial institutions, and the weak market discipline and bad business conditions. So what does these two factors lead into? So the decline in the balance sheet position, rather than I should rather saying decline, the more appropriate word would be deterioration of the balance sheet of banks, or you can also say financial institutions. So that it can be NBFCs as well as and other insurance companies, as well as along with a tough business condition. Why do I say this? As you know, the as the asset price bubble bursts, the prices of asset come down. When they decline, the value of collateral along with it. Value of collateral also declines. As a result, for particularly for banks and financial institutions, the business condition is tough. So they have to pull back the lending. And then these two factors can be a recipe for insolvency of the banks. So they might lead to insolvency of the banks. Now, when the banks start becoming insolvent, when more and more banks start becoming insolvent, what happens? There is a banking panic. So this insolvency, if it's of one or two bank, okay, it might be natural. But if say two, three, four, five, six big banks of the country are becoming insolvent, so it might lead to a bank panic. So what is a bank panic? Bank panic is a situation in which multiple banks fail simultaneously. So, okay, we can see that there is a bank panic with the onset of a banking crisis. Now, what happens as well as we also saw that there was an increase in the uncertainty in the market. Now, when there is an uncertainty about the health of the banking system in general, so there is this uncertainty about the health of the banking system in general. What does it lead to? This leads to something known as bank runs. So here was a bank panic, and now you have bank runs. So what is a bank run? Is that people rush to the bank to withdraw their savings, to withdraw money from their accounts. So this is a bank run. And if in a day, say all the people or majority of the people went to a bank and start withdrawing their funds, obviously the banks won't be able to lend further on. Furthermore, so now you should know that there are two kinds of banks. So there are good banks as well as bad banks, because these bad banks are the banks who made risky lending. Now you would say that okay, in the face of the crisis, it would be reasonable for us to assume that at least good banks are the banks that would withstand the test of time. However, what happens during a financial crisis? there is a sale of assets to raise funds, because because there is bank run, people are withdrawing their assets. So there is usually a sale of assets to raise funds so that government can pay back the savers their amount. It's not to lend actually, it is the amount is to provided they say they sell their assets to raise funds so that they can pay back the savers who have come to withdraw their savings. So these assets can be the government bonds and other stuff. So what is this known as? This thing is known as fire sale of assets, because it is happening just like a fire. So this is a fire sale of asset. So when you know that there is supply of an asset but the demand is not so much, the prices of the assets will fall. Prices will fall. And now as the prices of the assets have fallen, what is the thing? The net worth of bank also decline. Net worth of financial institutions decline. And as a result, the bad banks were plunging into disaster. The good banks had also plunged into insolvency. And this network decline might become there is insolvency. In insolvency. Now, in this scenario, do you think only that all the banks won't work? No, no, certainly not. There are only now in this situation. What happens if your economy had maybe 10 banks? Let's say maybe 7 banks have become insolvent in an adverse financial crisis. So you are left with 3 banks. So, what is the essence of this? We mean that few banks are operating in the market. So, when there are only few banks, you can assume that it's a sort of a monopoly. So, obviously, there would be some problem of asymmetry. So, there is a asymmetric information problem. These large banks can withdraw information from the savers, and this deepen the financial crisis. So, in the next class, we'll study the stage 3 of the financial crisis, that is debt deflation, which is something new and I hope you'll enjoy. For the time being, bye bye.